This show is strictly for educational purposes. The opinions expressed on the show are personal to the individuals appearing in the show and not those of Thinking Tree Ecoholics Private Limited. The show is not intended to offend or defame any individual, entity, caste, community, race, or religion, or to denigrate any institution, person, living or dead. Listener discretion is strongly advised. Welcome to Ecoholics, the Thinking Tree series, a talk show where we invite intellectuals and professionals to talk about various economic issues. I'm Asavari, and today we have a very special guest with us today, Ms. Renu Kohli. Ms. Renu Kohli is a Delhi-based economist with long experience in macroeconomic policy and research. Prior to this, she has also been the lead economist for G20 research program for the Department of Economic Affairs, Ministry of Finance, and even ICRIO. She has been a former economist of the International Monetary Fund and the Reserve Bank of India. And also, she's a regular columnist for Mint and Financial Express, besides occasional contributions to Business Standard also. We are really grateful, ma'am, to have you here with us on our talk show.
Thank you very much for the opportunity and for inviting me. And I'm very pleased to talk to your viewers, who I understand are mostly students.
Ma'am, today we are going to talk about the discussion of today is basically on the balancing of the economy to counter slowdown, which we have been experiencing since a year. So my very first question with this regard is, in the current scenario of the pandemic, the government is trying to provide fiscal stimulus. And looking at this, how can the government also work on a credible fiscal consolidation strategy?
Yeah, that's a very difficult task and, not painless. In fact, it is going to be quite painful. Let me just start that the economic slowdown has been going on since after 17-18. So, it was a 3-year prolonged economic slowdown and before COVID. And now COVID has impacted very, very badly. So, as for the last 2 years, the government has been also facing an intense shortfall of tax revenues.
Right.
And the fiscal space is completely squeezed up. Even it was dried out completely even before COVID struck. So, the credible, but having said that, there is no option for the government at this point except to provide support, because it's such a health as well as an economic crisis.
Right.
So, essentially, this is a credible fiscal consolidation strategy is a medium-term objective. By that, I mean in the next 2 to 3 years, and after the pandemic ends. And currently, the government needs to and has to and must spend. So to start with, a credible fiscal plan will actually transpire in the backdrop of successive failures to adhere to the past previous fiscal consolidation path, and that was expected to designed or planned to reduce the government debt to GDP ratio to 60%. Now, even before COVID, India was already in the 70% plus region. So that's the starting point. Another fact to be borne in mind is the 3-year-long growth slowdown was, as I said, accompanied by major revenue shortfall. So it gives us a sense of the weakening revenue side of the government balance sheet. And therefore, any fiscal consolidation strategy will have to fall harder on the expenditure side, which is the government spending. Now, expenditure reduction, restraint, and reorientation, that is to, a switch to improve the quality of expenditure and get more bang out of the buck, so to say, out of the government spending, is the overarching blueprint that I think has to be the case. Now, details do involve hard decisions, and these are not politically easy to take, and they can be politically costly. And remember, economic policies or, any kind of consolidation strategies are always also located in the political economy. So we must bear that in mind. So, most expenditure, as your viewers might be knowing, but let me just go quickly through this, they can be broadly classified into essential and discretionary. So, in the former would fall things like payments or commitments like salaries, pensions, interest payments on past borrowings, etc. Now, these are rigid. They are inelastic for consolidation, although in my assessment, here too revisions will have to be necessary. And, a preview of that we've already got, because right away in April, as the pandemic struck, the government froze the dearness allowance increases of the government servants. Now, it has already frozen it till next year, that is till June 2021, and with effect from April 2020. And government servants will also not be paid out any kind of arrears for the period. And the resumption is supposed to be at revised levels, that is upwardly revises. My sense is that there is a big question mark over whether this will be done, and it's more likely the case that the wage freeze can be extended, so that in real terms, or after adjusting for inflation, this would amount to actually pay cuts. So, that's where the, discontent can come in, or the pain. It is going to be painful. So the largest component on the discretionary public spending side is about 1% of GDP, and it is on the subsidies. Of this, the largest is the food subsidy, and a reduction in this component, in my view, as per any kind of credible fiscal consolidation plan, is an absolute necessity. And it will become inevitable, if only to, so let's assume that the government actually bites the bullet and introduces or plans in its consolidation strategy about 10 to 20 BPS of subsidy reduction each year. And so in my view, actually, this has not happened in the past consolidation program at all. But if the government does make a beginning, it will release substantial fiscal space that is permanent in nature. And those resources can be reallocated. For example, how the government has been managing even before COVID has been by rolling over subsidy payments, unpaid bills to FCI and so on. So, starting on this component would be a very good way to regain credibility with investors as well as rating agencies. Now, what can be done on the revenue side? Now, there are both tax as well as non-tax revenues. Now, unfortunately, at this point, when growth is commonly expected to be deeply negative, then it is not the right time to raise taxes, in my view. As it is, the government has been raising taxes quite severely, if I may say so, upon fuel prices. But at the same time, it is heavily dependent upon that, and it's a very narrow base, and it cannot go then forever because consumption is going to take a hit. So, it will have to raise taxes. Now, on the direct taxes front, there is personal income tax and there's corporate taxation. Both of them have a narrow base, and therefore they offer limited scope for additional revenues from raising tax rates. So the tax administration will have to increase their efficiency and compliance. This has never happened before because we've had many series from the 90s. We've had many tax reforms, VAT, GST, and on the direct taxes side, rationalization and so on. Yet India's tax base has remained narrow. And that's a sorry state and poor commentary upon our affairs. Because if you take a comparator country like China, which introduced VAT much later than India did, its tax to GDP ratio continued to increase, which means that the base widened. And in India, that hasn't happened. So, there has got to be a serious relook as to why on the tax agency side, tax administration. I think that the government can, on the direct taxes front, can also take a very hard re-examination of the agriculture income. This has been a long-standing exemption, right, post-independence, and it is reported to be a source of tax evasion and avoidance, and some kind of re-examination and an introduction of a gentle introduction can be looked at. On the indirect taxes side, it is inevitable that GST tax rates will have to be revised. And there have been recent statements by the senior officials in the Ministry of Finance that this could be the rationalization and harmonization, which means that there are too many items in the lower band, and they will be pushed into a higher if they have just come to two rates. So lower items at 5 to 12% may move up to a revenue neutral rate at about 16 to 18% band or something. So I think that is going to happen. They said it can happen as soon as at the end of the year, although they did not say they will raise it, but they did say this. So that gives us a sense. Now let's look at the non-tax revenue sides, and this mainly consists of public sector and RBI dividends, PSUs, which are called public sector undertakings, auction of licenses, spectrum fees, charges, and disinvestment of public assets. Now, only the disinvestment has any kind of scope, given the weakened financial positions of all PSUs, the weakness of the telecom firms, and their lack of appetite in participating in any kind of high bids of auctions or spectrum revenues. So, public asset sales, as we all know, are subject to market conditions. And they're also subject to the investor appetite. Unfortunately, this is not a very, very good environment, and therefore, it can be very selective. And so targets at the beginning of the year could be, must be very realistic, and we must not expect that this is going to happen in one go. It has to be a continuous progress. But I would just like to make one qualification that given the past history, evolution, that every time the public asset sale disinvestment targets are not met, the government, it's only the fiscal deficit is increased a little bit, under some other escape clause or the other. But actually this time around, it should be accompanied by a matching expenditure reduction, so as to keep the fiscal gap within bounds, because India's fiscal history of indiscipline is so very poor that unfortunately it's not going to be easy. So, to sum up, a credible strategy must consist of both expenditure rationalization and reduction, along with revenue-raising measures from both taxes as well as non-tax revenues over its next several years. And because growth is going to be very adverse, and it's not going to be, we're going to see a very sharp contraction next year, and even the next 2 years, we are not sure as to what kind of recovery that is going to be there. So we can say goodbye to sort of strong growth rates for some time. So it's going to be a painful adjustment. Overall, I would say India is going to face a difficult economic period for several years now ahead.
I think, ma'am, it was quite insightful because it was quite comprehensive that you have, pointed out each and every aspect of the strategy. And I believe the students would definitely note down a few important points regarding the strategy and how the future growth will be from now on. Now, coming on to future growth prospects and our ambition to grow further, according to economic survey, India was not able to attract any kind of desired private investments. How do you envision the importance of foreign investments and in private investments to encourage the growth, maybe after the pandemic or even during the pandemic? What is the significance of these private investments?
First of all, even before at the, when the government announced in its 20 or 21 trillion package, of economic support, relief package or whatever, the government did, touch upon a lot of reforms in the FDI, basically relaxations. Some of them were old and they had already been done and they were presented as, part of that. But overall, I mean, there has been a lot of liberalization of the FDI, including in coal, insurance and aviation and defense. However, the truth is that very little FDI has come in, and I will focus upon that as fraction of GDP. We have nowhere touched still levels that India saw in 2006, 7, and 8.
Right.
But however, let me just talk quickly about how beneficial FDI is for economic growth, and the benefits are very, very well acknowledged in the literature and by cross-country experiences all over the world. Especially for developing and emerging market economies. they can actually achieve very rapid growth rates as part of catch-up growth, because the technology frontier, the international technology frontier is given for them, and therefore it's very easy for them to sort of adopt very state-of-the-art FDI through by making their countries more attractive for such investments, and then moving up the growth trajectory. So investments, what happens? Why is it beneficial? Through investments, foreign firms bring in new technology, technological processes, more efficient ways of operations and procedures. They increase also competition with vis-a-vis the domestic firms. So overall, there is an increased efficiency enhancement and productivity enhancing effect through spillover effects, not just in the sector in which the FDI is coming in, but also in other parts, larger parts of the economy. And one example that I often like to quote is that in the early 90s, when FDI was relaxed, we had McDonald's coming in, and just see, what that did to Haldiram. I mean, or, Haldiram came about, and I quite think that, had that fast food innovation not happened in traditional Indian foods, I think in large part of that was the entry of foreign firms. So it's very, very beneficial for growth. And in particular, let's just look at export-related FDI. That enhances a country's external competitiveness even more, because your exporters, domestic exporters, are able to match up to those kind of standards, which are international standards, and compete, and sometimes even exceed global standards if the ecosystem stabilizes very, very well. Also because export-oriented FDI operates at very, very large scale. This is to, harness the scale economies. And therefore, its employment creation potential, particularly in manufacturing sector, is very high. And investments in manufacturing, FDI, export-oriented FDI investments into the manufacturing sector, they have the capacity to employ vast numbers of unskilled, semi-skilled, as well as skilled labor. Now, we all know that India has a vast abundance surplus labor of that, which continues, about more than half of it, nearly half of that labor continues to be dependent upon agriculture, even as agriculture's share in aggregate output falls by roughly, each year it declines by 1 percentage point. So, there is a big problem out there, and unfortunately, India has not been able to adopt this route to growth in a sustainable or meaningful manner. And the reasons for this are quite well known, but let me just recount them. It's worth recounting them quickly, which is related to India's poor infrastructure quality, high production costs, which cover everything from high cost of power, high cost of high interest rates, and as well as red tape, other bottlenecks, rigidities in land and labor markets. Even though India has the common advantages of low wage, surplus labor availability, which is common, which it shares with countries like Bangladesh, Vietnam, Cambodia, etc. in the current environment. And previously, a few years ago, about a decade ago, or a little less than a decade ago, with competitor nations like China. But now currently, a lot of FDI is relocating, has relocated in the past 2-3 years, but very little of it has come to India. Somehow they have chosen Vietnam and Bangladesh. And there is one other matter which matters for export-oriented firms to come into India, which is the external market access, which is typically a lot of governments, because it's such a competitive environment ever since the global financial crisis happened, and the trade volumes all over the world have declined so steeply, and they've never really reverted back to former pre-GFC levels. And so competitor nations have actually secured a lot of market access through signing quickly trade agreements. And very recently, Vietnam has actually secured a FTA with the European Union, which is a very, very large importer. And during the pandemic. So you see, the agility and the quickness and the alertness with which other governments act is somehow not done in India. And so, market access is a big issue. And there is a large role for government intervention over here, I would say. And the biggest testimony to India's lagging rank as an attractive FDI nation is that lesser and lesser fractions of FDI are coming into manufacturing compared to more of it is coming into the services sector in India. And of that, even the one that is coming, both actually, whether it's services or manufacturing, but especially in manufacturing, is not what you call greenfield investment. Greenfield investments are fresh investments. And when fresh investments are made in setting up a plant or, acquiring capital equipment or a new factories, then your overall aggregate investment expands. So, the country's productive economic capacity expands size of the economy. It has unfortunately been more of brownfield, and brownfield FDI we refer to is, you are acquiring existing assets, whether this is done through outright purchases or it is done through mergers and acquisitions. No fresh capital fixed asset creation takes place. So, this is something that these are some aspects that India has to the government has to, policymakers have to examine very deeply as to why this kind of phenomena are coming about. So, that's, even despite the fact that in the last 6 years, we've had a series of reforms which are structural in nature. India moved to inflation targeting, then, there was this GST. I do not know whether demonetization can be called a reform, but at the same time, there have been a series of, which I already mentioned, there have been a lot of FDI relaxation and liberalization. And India has also climbed, as per the ranking in the ease of doing business. It has been steadily climbing up. And yet, it is not reflected in, large-scale FDI coming into the manufacturing segment, or for that matter, greenfield investments. So, this is something that, why this is happening. And last of all, let me just put it this way, that for any investor, whether foreign or domestic, the environment matters, which is your demand outlook. Again, because of COVID-19 and all, the demand outlook has not been good, and the cycle has been on a downswing, at least the Indian cycle in any case for the last 3 years. So that also makes a difference. So, I think I'm done about that.
Yes, that's, I think, quite rightly put. There are so many phenomena that we are experiencing right now. Now, coming on to my next question about your experience with RBI. Now, because you have had a long experience with the Reserve Bank of India and its operations, could you explain, with your experience and expertise, how can we try to, I would not say how can we strive to strike a balance, but some kind of steps or some kind of foundational principles on how can we strike a balance between monetary and fiscal policy that we have had a lot of tussle since years, and still sustain and maintain RBI's autonomy in all those tussles, in all those observations. Because we have been reading newspapers and news articles, and always we as students and we as readers would find that there's always somewhere loss of autonomy, probably. But how can we sustain that RBI maintains its autonomy and still strikes a balance between two tools?
So before I go into details and explain the main monetary and fiscal tools through which undermining or fiscal dominance, so to say, can transpire in the Indian context, let me just mention two main institutional changes. And the first one was very significant. In 1998, there was a separation of thing between RBI and Ministry of Finance. There was an agreement in which the automatic deficit monetization, which used to happen by RBI automatically, accepting treasury bills and buying them, and the government borrowing infinitely. So that happened. That was discontinued. So thereafter, the RBI could only operate in the buy government debt in bills or bonds in the secondary market. That is where the banks are operating. So, that has been one institutional feature, and that actually went a long way in establishing Indian policy making credibility with foreign investors. Because if you look at it from the international investor point of view, they look at credibility of the institutions, and in particular, because the central banks set the interest rates, that is very, very important. And as we all know, that from 1991-92 onwards, India's equity as well as, and initially the stock market was opened up to foreign investors, and then slowly the debt market, that is the bond market, has also been opened, although that is still not fully free, but the equity market is, right? So, and the second is that in 2015, they introduced was the introduction of flexible inflation targeting. Now, under that also there is an agreement, there is an inflation target, and the RBI is bound to keep inflation within, at 4% plus minus a band of 2% up or down. And failing which, if it fails to meet the target for 3 successive quarters, then it has to, go to the parliament and explain why this has happened. Now, that is an agreement on paper, right? And it's not that RBI did not have a medium-term target earlier. It always did. There was about, 4 to 5%. So it was always there. And the third thing that has happened under that regime is that earlier they had an advisory committee, which was a monetary policy committee, which was informal and advisory in nature. But after 2015, the decision taking has become more broad-based, and it is mandatory for the decision interest rate setting to be done by the MPC, or the Monetary Policy Committee, which is a 6-member body, out of which 3 are insiders from the RBI, and the other 3 are outsiders appointed. So now just let me quickly go for the benefit of your students as to, what are the main monetary and fiscal tools, because, that what I said up till now, it may be a bit difficult to understand if we do not, cover this ground. Right. So the main monetary policy has many, many instruments that can be both direct as well as indirect. Now, in India, the main policy instrument is the repo rate. This is the rate at which the central bank injects liquidity into the economy, and converse is the repo rate through which it absorbs or sucks out liquidity. And depending on conditions, the other liquidity tools are LAF, which is liquidity adjustment facility, marginals, MSF financing, or the open market operations that are of most frequently used. And, LAF and MSF are for temporary and, daily adjustments in consonance with the current prevailing monetary stance, whereas OMOs are more for used for more durable injections or removal of liquidity in the economy. And there is also the CRR, cash reserve ratio, which is sparingly used nowadays, and there is always an issue of whether it's a monetary policy tool or a precautionary tool for reserves keeping. So should there be a run up on any bank? And then there is the SLR, but that is more prudential in nature, and over a period of time it has been progressively reduced, and that is by design. The policy is to continuously bring it down so as to release more resources for the private part of the economy in terms of access of credit from the banking sector. And finally, there is this bank rate, and there is also the RBI also has the scope for adjusting the corridor between the reverse repo and the repo rates, depending on how it wants to operate. Now, the monetary fiscal interface transpires through interest rate setting. And this is where an independent central bank takes a decision. I have already covered how this is happening nowadays. But over and above all this, there can still be pressures from the government. So, these are institutional mechanisms. And because, things are set out and there is an inflation target, at the same time, that does become a kind of, I would say it has a deterrent effect. Because investors are watching and they are proceeding as per that. So any kind of, overt pressure or deviation from what, the path would be, the gap between actual and realized or forecast inflation, or the gap between potential and actual output, then I think it would undermine credibility. So I think that is that effect is, of course, there. And I've already said what I did earlier. Now, last of all, let me just conclude by saying that keeping inflation within target or the objective, it can be accomplished by the RBI only with cooperation of the government, because on the fiscal side, the government fiscal policy has two tools, as we all know. One is the ability to change tax rates, and the second side, or the other side, is the ability to change its spending program. And through those two tools, which are very powerful tools, and they have an immediate impact, unlike monetary policy, which takes about 3/4 of roughly about 9 to 10 months to have any kind of impact upon aggregate demand. Fiscal policy is a very potent tool because it affects aggregate demand very quickly. It is transmitted to that. So, there's no point in RBI, holding on or having a particular monetary stance, whether it is tight or neutral or accommodative kind of monetary policy, if the government goes ahead and spend. And therefore, boosts aggregate demand. So the problems can transpire from that side. And therefore, we have to keep that in mind. So, that's where fiscal dominance and cooperation can transpire. There is also the power of money creation that the RBI has, the ability through OMOs to influence the market rates, or what we call the so-called yield curves, which the long bond yield serves as a reference rate for the banks to set their lending rates upon. And there also, infiltration can take place. So, despite all these institutional mechanisms, you can still have infiltration and dominance. There is also finally the temporary ways and means advances, which are of short duration, but meant to, bridge over temporary mismatches in revenues and expenditure. But increasing recourse to that is also a kind of, it's basically direct deficit financing. Unfortunately, in the last 2-3 years, that also has been on the rise.
Right. Now, something that you have touched upon a little, I'd ask a question regarding that, which is the Forex reserves. Now, this question is again something that we would just want a generic view of yours. Now, recently, India has seen that the Forex reserves has reached a new high of 500 plus billion US dollars. How can India judiciously utilize this strong macroeconomic fundamental to its advantage, seeing the current pandemic scenario, and also if we really want to boost growth or inject money in the economy in that perspective?
Let us be clear. I think the utilization of the Forex reserves is already being done, because what is the objective of reserve accumulation? It is basically to provide a cushion against unanticipated capital outflows, external account shocks, which could come from either side, any side, and a sudden exit of capital. So what do reserves do? Reserves are there at hand. They are a kind of a self-insurance. They provide immediate liquidity, which is unconditional, because, if you look at other access of liquidity, say access from or going to the IMF, those are all conditional. So this is unconditional. This is immediately available for hand. It allows the central bank to buy time to, use other mechanisms, or for the government to, put in capital controls or import controls, etc., whatever might be the need of that time. And therefore, the central bank is able to moderate the path of adjustment in the exchange rate, because any kind of disturbance on the asset side in the goods market or in the asset market, which is your capital account or your current account, it reflects in the price, right? And that's the exchange rate. So the reserves allow the central bank to, that kind of flexibility to stabilize the volatility, moderate the path of adjustment, and stabilize financial markets in turn. At another level, what you call about the self-insurance, or a kind of a signal to impart comfort to external investors. Well, the external vulnerability side of it provides a cover. What are the covers? I mean, it provides a certain cover for imports, for example, short-term debt of India, the aggregate, which is due within the next 1 year, and beyond that, other external debt. Now, these are the key external vulnerability indicators that investors typically look at while appraising a country's profile.
Right, right, of
Okay,
course.
even credit agencies. So,
Well,
the reserves are already discharging their role.
yeah,
One
all
can
right.
have a debate or merit about having large accumulation. The second point I wish to talk about is that these reserves are actually they're accumulated from surplus capital flows. What
Mm-hmm.
is the surplus capital flows? That which cannot be absorbed within the in that time and place in the markets
Mm-hmm.
and by the markets and by the real economy. Okay,
Yeah.
whatever is surplus can actually make lead to an overshooting of the exchange rate,
Mm.
make it very highly appreciated,
Mm.
or which is called overvalued, and therefore when the adjustment happens, when the capital flows subside, you're going to see a sharp fall, which
Mm.
is neither of which is desirable, and it is certainly not very good for real economic activity such as your import and export planning.
Mm.
So, these reserves are accumulated, unfortunately, India from excess capital flows, which
Mm.
means when an investor buys shares in
Yeah.
the stock market or it buys government bonds, there is an obligation, there is a liability. So
Mm.
these are accumulation of foreign liabilities and these are paid for.
Mm.
India as a whole, the country through the Reserve Bank is paying a cost of accumulation of these reserves. Unlike countries like China, which earn these reserves.
Mm.
China's reserves of about approximately 3 trillion
Mm.
cannot be compared with India because they are earned from export earnings.
Mm.
It has always for many years it has run current account surpluses, and
Mhm.
therefore these are actually earned reserves.
Mm.
India's are, to put it in an opposite sense, are
Mm.
borrowed reserves, and the
Mm.
cost of the reserves, what you see is paying, is the foreign and differential interest rate differential between foreign interest rates and the domestic interest rates. So
Mm.
for example, the return, if you see our long bond yield, currently it may be in the 5.8, 5.9% region,
Mhm.
and the US 10-year treasury is at around 5.5. So roughly the interest differential. So the overall, the earning on these reserves has been in a long-term sense is under 2%, maybe about 1.6. And in some years, depending on the movements of the dollar, because much of the reserves are invested in dollars, then
Right.
it can be as low as 0.8%. So that's the price you pay, right?
Mm.
How does it manifest into the economy? Well, the RBI's profits or surpluses are reduced to that extent in terms of the payout.
Okay.
And therefore, because by law and because the surpluses are transferred to the government of India at the end of the RBI's fiscal year,
Yeah.
financial year, so the profits are, or the dividend or the surpluses are reduced to that extent. Having
Mm.
said all this, I think these are theoretical and well-known practical issues.
Mm.
There is always we come across this thing about, there is this 500 and plus billion of reserves. Why is it being kept there? We can use it for infrastructure financing and so on. All these suggestions for using them for infrastructure financing, and as you asked me, can it be put to more productive use?
Yeah.
Then they just miss the point that net foreign assets, which is in rupee terms, every time the RBI purchases for foreign currency, it exchanges it for
Mm.
domestic currency, and so it is part of what you call the monetary base, which is reserve money. Very simply put, reserve money or the
Mm.
base money can be divided into net domestic assets and net foreign assets. And net foreign assets are simply your foreign stock of foreign assets converted into
Mm.
rupees. So, they're part of reserve money or base money. So, any usage of infrastructure financing, or for that matter, for any other thing, paying bills, whatever, are
Yeah.
actually have a potential monetary impact upon money supply. And therefore,
Yeah.
they are subject to that. It also sets a very bad precedent. Today, we may say that it is a pandemic. Few years ago, it was, at any point in time, it's always infrastructure deficit and infrastructure financing. It's always
Mm.
there. So,
Mm.
we all know that very well,
Mm.
that how pressing a need is always in the hands of the government of the day to define.
Mm.
So you
Right.
can't play fast and loose on this. You
Mm.
have to have norms and you have to be very serious about it,
Mhm.
right? So,
Right.
there is this moral hazard issue over there.
Hmm.
And the third is that it just undermines the political will
Of
to
course.
raise additional resources, which has to be through structural improvement in your tax to GDP ratios
Right.
and widening the base.
Hmm.
Why would we want to go this path on such a short-term policies?
Hmm.
So, these are not, and finally, let me just end this by saying that there are also judgment issues involved in deciding what the reserve adequacy is. And as I said, that there are, typical yardsticks by which short-term debt to cover reserves ratio is measured, by which, the import months of import cover are measured.
Yeah.
There is also the issue of foreign liabilities. As I said, that these reserves don't really belong to us; they are borrowed.
Yes, they're borrowed. I think there's something really a bigger perspective that we have gained out of that question, I suppose.
Thank you. I was very keen to speak on this because I have written about this, but it's very
Yes.
nice to reach out to a larger audience and provide them the serious perspective that is required into these issues on the
Actually, it is,
merits.
of course, actually, it is reading between the lines of all these theoretical issues that are presented.
Yes,
So,
yes, which are
I think,
ignorant, I would say, and politically driven.
unfortunately. So, really, that's really, we are really glad to have that kind of discussion. And finally, concludingly, the last thing that I would like to touch upon in this discussion is about the MSMEs. Now, this is again, why do I take up this as a very important and significant part of the discussion is because there's been so much written and there's been so much said, but still a certain expertise on it and a certain, a certain emphasis on it would always be required to for understanding, or especially for the students. Now, my question is, it seems that the unfortunate time of MSMEs is a never-ending struggle. It's like a loop. As it first started in the as
Yes.
the roadblock of demonetization, then GST happened, and then the COVID happened. And it's not just these three things. There have been things in the past as well which have been a roadblock to the growth process of MSMEs. How can we prepare for these backlashes in the future as well? What is your opinion on this?
First of all, we are all taking it for given that, the MSME problem is, very, very large and all. But how do we know the extent of the magnitude? How do we know in which sectors they are suffering more and less? How do we know where the shocks or the hurt or the injuries have come from? Do we know about that? Have we come across any kind of, authentic and a comprehensive survey of the sector? I keep coming across FISME, which is the Federation of Indian MSMEs, etc. They say this, they say that, and all. They do that surveys. But in the last 3-4 years, you mentioned the shocks, which is, demonetization, GST. Has there been any kind of official survey, which ought to have been, to quantify the problem, to measure the problem, the magnitude, to identify as to, where the injuries are coming from? Whether it's from the, declining exports or declining global side, first of all, whether it is domestic or global, A. B, within domestic, was it demonetization? Was it just slowing growth, which affects all segments and all industries, large, medium, and small, and the services sector? Then again, is it because GST has raised the compliance costs of meeting the requirements? And if so, by how much? Or is it the GST tax rates in some segments? So we do not know. We simply know that their loans have been stressed. We also know at the same time that the growth cycle has been on a downswing from 17-18 until now. But we also do not know the causes of that slowdown. That remains a speculation. I, as an economist, say one thing, Another economist says another thing. There is this thing, but there is no authentic, or official source which says, or a white paper that tells us that, okay, we have done this, conducted this analysis, and the slow causes of the slowdown are the financial sector weaknesses, as is largely believed to be the case, the ailing sector banks, public sector banks, or the unresolved large amounts of NPAs which are sitting, like the power sector and a lot of infrastructure, etc. No one knows. So we are flying blind out here.
Yeah.
And policy or whatever, any kind of responses, which is the chief response in the last 3 years has been to give them regulatory forbearance in terms of the GST compliant MSMEs with turnover above 25 crores were given, this thing that they will be treated standard accounts for a year, and then it was extended up to January 2020, and then just yesterday or 2 days ago, the RBI extended that again to till for the next 2 years. So we know that stress is coming from there simply because they are not unable to repay their past debts. So their debt repaying servicing capability is weakened. That is also true, by the way, of large industries as well. And we also know that there is no credit offtake. Now, whether banks are not lending or there is no demand, we don't know. Demand supply are intermixed out here. So pouring credit or waiving of loans do not constitute lasting solutions. My only recommendation or advocacy would be that try and get the growth cycle going, no matter what. Do what it requires to be done. Even if it's publicly not known why growth has slowed down, at least the policy makers must know. Because even interest rate monetary easing is not working. So depressed is the environment, and it has been so pre-COVID as well.
Yeah.
Last of all, let me just put it this way, that I think they're integrating them into the part of the larger chain, which is called the global value chain.
Yeah.
But is one important structural shift that can transpire. But from what I know is that the scale at which these global value chains operate in Taiwan and in countries like Indonesia, Malaysia, Vietnam, Thailand, etc., where their small and medium firms are very, very well integrated into the global value chain. The scale is very, very large. Very large.
Yeah.
So that is something which India has struggled with, even in terms of FDI that I spoke out. So that's something that can be looked at very seriously. That's all I have to say on the MSMEs.
Right. I think rightfully
I've been quite severe.
Yes, of course. And I think rightfully stated by you that lack of diagnosis has been the most, the biggest
Policy
problem.
can only respond and must respond to what the evidence is.
Right, of course. That was our discussion about the balancing of the economy, and I think we have had a large variety of insights that we can draw upon from this discussion. Students definitely would be really thrilled to watch this discussion with you, ma'am. We have already always been reading your columns, and it's always been a delight for us as well. So thank you so much for having your presence on our talk show and being so simplistically comprehensive. You have taken down all these concepts very comprehensively. You have discussed all these concepts, and in the very simplistic note to understand, to comprehend for our listeners and the audience, which is by and large the students. So thank you so much for coming on our show today, and thank you very much for your time.
Thank you for your appreciative and kind words, and thank you for the opportunity. And I hope your students benefited from the talk, and
Definitely.
I look forward to the responses. Thank you.
Thank you, ma'am. Thank you so much.